While many celebrate the S&P 500's latest surge, a deeper look reveals subtle shifts beneath the surface. True wealth builders aren't just reacting to daily headlines. They're dissecting the grand narrative of the business cycle. The allure of a booming market can be intoxicating. We see tech stocks hitting all-time highs, venture capital flowing, and our 401k statements look great. It's easy to believe this growth will last forever, isn't it? Yet, nearly 80% of retail investors lose money during market downturns, often wiping out years of gains in mere months. This isn't just bad luck. It's a fundamental misunderstanding of the economic tides. Consider the tech worker who rode the dot-com bubble from 1995-2000, seeing their portfolio grow by 300%. They expected perpetual growth, only to see 70% of it evaporate by 2002. This is the danger of recency bias. The market doesn't move in a straight line. It flows in cycles: expansion, peak, contraction, trough, just like the seasons. But investors often miss the shifting winds, fixated only on the summer's warmth. There are critical business cycle warning signals that flash long before the storm hits. These aren't daily stock tips, they're macroeconomic indicators that sophisticated investors, like Ray Dalio, study religiously. The 99% miss these warnings because they're caught in the daily noise. They prioritize CNBC headlines, social media trends, or the latest hot stock tip over fundamental data and long-term economic shifts. This ignorance comes with a steep price, delayed retirement, diminished generational wealth, and the constant stress of chasing markets rather than understanding them. It's a treadmill that never truly leads to financial freedom. Fear and greed are powerful forces. When markets soar, greed makes us overconfident, ignoring red flags. When they crash, fear paralyzes us, preventing rational decision-making or even seeing opportunities. The smart money, however, is detached from these emotions. They're not watching daily stock prices. They're tracking long-term trends in interest rates, unemployment claims, and manufacturing data to position themselves strategically. So, are you truly prepared for the next economic shift? Or are you, like the 99%, unknowingly sailing into a storm, hoping for perpetual sunshine? It's time to ask yourself, what signals are you truly paying attention to? The illusion of endless growth is a powerful one, reinforced by market cheerleaders and quick buck narratives. But history teaches us that every boom is followed by a bust, and understanding this rhythm is your greatest defense. Ignoring these warnings isn't just about missing out on profit. It's about exposing your financial future to unnecessary risk. It's about letting your hard-earned capital erode when you could be protecting it. To truly build generational wealth and achieve financial independence, you must learn to read the market's deeper language. This means moving beyond the daily noise and focusing on the true economic pulse. In our next segment, we'll dive into the specific macroeconomic indicators that signal major shifts. You'll discover which data points the professionals track and how you can integrate them into your own strategy. First, the Federal Reserve's interest rate decisions. A hike, like the 525 basis points seen since March 2022, directly impacts borrowing costs for businesses and consumers, a foundational shift for the entire economy. Such changes ripple through bond yields, making government bonds more attractive. Simultaneously, higher rates increase the discount rate for future earnings, often depressing equity valuations, especially for high-growth tech stocks. Next, inflation, measured by the Consumer Price Index, or CPI. When CPI surged to 9.1% in June 2022, it signaled a rapid erosion of purchasing power, a direct threat to your long-term savings and investments. High inflation forces investors to seek inflation hedges like real estate, commodities, or even specific value stocks. The goal is to preserve real returns, as nominal gains can be entirely wiped out by rising costs. Gross domestic product, or GDP, indicates a nation's economic output. A 2% annual growth is considered healthy for the U.S. Consecutive quarters of negative GDP, like in early 2022, officially signal a recession. GDP trends are crucial for corporate earnings. Strong GDP means higher consumer spending and business investment, translating to better profits. Conversely, a slowdown directly impacts revenue, often leading to market corrections. The labor market is another vital sign. Unemployment rates, like the historic low of 3.4% in early 2023, signal robust consumer spending. However, rising jobless claims can quickly reverse this optimism. Economists often watch the Phillips curve, which suggests a trade-off: lower unemployment might lead to higher inflation. Understanding this dynamic helps anticipate the Fed's policy responses and their impact on your portfolio. Purchasing Managers' Indexes (PMI) for manufacturing and services are leading indicators. A PMI above 50 signals expansion, while below 50 indicates contraction. The ISM Manufacturing PMI dropping below 50 in late 2022 was a clear warning. Consumer Confidence Index measures how optimistic consumers are about the economy. High confidence often translates to more spending, boosting corporate revenue. A sudden drop, like during the 2008 crisis, forewarns economic contraction. Perhaps the most potent recession predictor is the inverted yield curve. When short-term Treasury yields exceed long-term yields, as seen before every U.S. recession since 1955, it signals deep market distress. While macro data sets the stage, corporate earnings reports offer micro-level insights. A company's revenue and profit guidance, especially from giants like Apple or Amazon, provide granular detail on sector-specific health and future outlook. No single indicator tells the whole story. Professionals integrate these data points into a comprehensive dashboard. The art lies in identifying converging signals across multiple indicators, not just reacting to one headline. Amidst this data noise, a long-term perspective is paramount. Short-term market fluctuations, often fueled by daily news cycles, can distract from the underlying economic megatrends that truly shape wealth over decades. Your strategy must be dynamic, adapting to new data, not rigid. Continuously educate yourself on these indicators and how they interrelate. This vigilance is your best defense against missing critical turning points. This vigilance isn't just about avoiding losses. It's about positioning for long-term gains. When others panic, your informed perspective allows you to act decisively, potentially acquiring assets at a discount, much like legendary investors during market downturns. The true wealth builders understand that market cycles are opportunities for compounding. Think of the S&P 500's average 10% annual return over decades. Missing the critical bottoms means missing a disproportionate share of that growth impacting your retirement goals significantly. The average retail investor often underperforms the market by 2–3% annually, not due to lack of intelligence, but due to emotional decisions. Cultivating discipline and a long-term mindset is more valuable than any hot tip from Wall Street. Your financial future isn't predetermined. It's forged through continuous learning and unwavering discipline. Take ownership of your investment education, build a resilient strategy, and commit to the long game.